Markets with David Modell.
Welcome to Looking at the Markets with David Modell. Today I have a repeat guest. He is Mr. Dale Pinkert. He has been in the Forex and stocks trading game for quite a while now, and he really puts me to shame because, you know, when I say something stupid, he calls me out on it, and I totally deserve it. And I like to joke around with him, but he is, I consider, a mentor in the Forex game, the stocks game, the futures game, commodities, pretty much anything you could think of. And he is the mind behind forexanalytics.com, forexanalytix.com. I'm going to put that on the screen and in the link in the description below this video. Also check him out at Forex Stop Hunter on Twitter. He's going to teach me a few things. He's going to school me today. So, Mr. Pinkert, welcome back to Looking at the Markets.
David, thank you so much for having me back. The reason I wanted to do this is I believe we're at some inflection points in the market, and inflection points are serious business because people get used to trading one way, and when I begin to see signs that we could become not one way but binary and start getting two-sided markets, I think it's a good time to talk about it.
Yeah.
Just one correction, I'm one of 6 very good minds at Forex Analytics, part of a great team. And in fact, what I could do, and I will in a minute, is just show you the team.
Cool.
And I'm actually very proud to be part of it because I interviewed all of these guys and ladies when I was at FX Street running the live analysis room. Blake and Nick and Grega. Grega won awards on FX Street. Stelios does macros. Steve is one of the most disciplined traders that I've ever met. So I'm here to talk about these inflection points with your audience today. So I want everyone to keep this in mind. It's the most important part. I know it's different than what you get at a lot of interviews, but check it out.
Okay.
Use less leverage when you trade the market. Use wider stops so you don't get picked off. If you don't use less leverage, you might lose your head and your account will be dead. Whereas most people, David, they use max leverage, turn $100 into 10K. They swing for the fences, try and get rich in a day. If you use max leverage and you miss on that play, your account will go away.
Hey.
Use less leverage. Use less leverage. So trade small out there, everybody.
Yeah, all
so
right.
The market can be forgiving to you. So I want to start off with what I believe is the linchpin to everything, David, and that's a dollar. So I was going to either talk about the dollar index or what the dollar index is mainly comprised of, and the heaviest weighting in the Dixie is the Euro USD. So we've had a pretty good year. We had a great 2017. President Trump wanted a weaker dollar. I don't know if he was behind it or it was just because of the fact that there was QE eventually was going to come to an end and we were tightening, and a lot of people were fooled because they thought higher yields would mean a higher dollar, and in fact what it meant was a weaker dollar because higher interest rates can actually weaken an economy. Right. So I want to talk about where we're at right now in the euro. So if you were just looking at it from 2017, you would go, wow, this is an ongoing bull market, but you get the bigger view and you go back to where the highs were made, and actually we have higher highs in here, but this was the Draghi during the Euro crisis where he said, I'll do anything I have to do to reflate the economy, and this was a huge decline, almost a 40-cent decline in the euro against the dollar. And then we had a little bit of a turn here, a nice turn, pretty classic. I teach this. It was actually a false breakdown. most people would have had a straight line, see this red line here,
Yeah.
and they would have said it was breaking down, when in fact what it was doing was diverging at new lows and set the stage for this big rally that we've had in the euro and dollar weakness. And when you think about it, we really had the dollar be down, I don't know, about 15% since the beginning of 2017. And we have the stock market up 30% or so in the same time frame. So I'm not saying all of the gains in equities were nominal because of a weaker dollar, but definitely this was a tailwind in the market. So I want to bring up that this tailwind may begin to slow and possibly turn into a headwind, because we're approaching some levels here that we're already halfway back of this big decline. A lot of people think we could trade even up towards 126. I'm seeing the euro begin to struggle here. And in fact, David, you're probably familiar with commitment of traders reports.
Yeah.
You know, I used to use them. The big mistake people make using COT is that they try and be on the side of the commercial trader. But commercials are banks. They have deeper pockets than individual traders.
Right.
They can be early. They usually are early. And then you're trying to fade the hedge funds and fade the small spec. Well, we have record net longs from all the way down here in this zone. And I was saying, because I was still positive the euro, and I thought we'd see at least 122. I was saying, well, if it's a crowded trade down here, I wonder how much more crowded it would become if the euro took out these highs and made new highs. And it has become more crowded. And we're actually getting some weakness in the euro-pound pair, which is showing euro weakness against the pound, and I use that for a lead indicator. So my basic point is that this phase of dollar weakness could be coming to an end, maybe not the type of end that the parity bears were looking for, under a buck, under parity. During this whole time frame, everyone was chanting under parity, kind of like the grain traders used to chant beans in the teens. But why not a 50% retracement that could take us back to 114 or so in the coming months? So I'm starting to see some negativity, some divergences developing here. Maybe we get 124 and a half, 25, maybe 26, but actually I think that we could be beginning to make some type of turn in the Dixie right around the 90 level. Shouldn't be any worse than 88 and a half. And even if it's not the renewal of a new bull market in the dollar or a new bear market in euro, it should be good for intermediate term type bounce, where the Dixie can bottom between 90 and 88 and a half and make a rally back towards 97. You know, a lot of the people that are bearish assets across the board are still deflationists. And one of the things that's been happening with the Fed tightening is that the yield curve is really flattening. And I'll get to the bonds in a little bit.
Yeah.
But I did want to talk about the fact that the dollar is the linchpin to most other markets. It's bigger than the bond markets, and the bond markets are bigger than all the equity markets on the planet combined. So very important to know which direction the dollar is going to head. I'm thinking that we're getting close to a bottom in the dollar. I think it could take maybe through month's end, maybe even into the spring. But sentiment, and so many people are long the euro right now that the euro is starting to struggle to make new highs. So on a shorter term basis, which is something I could show you here.
Sure.
Here's the euro. As you can see, you know, we tried to rally today and we weren't able to do so.
Right.
I teach a 3-drive pattern, but to me it looks like we're going to get a dollar rally here. And maybe it's only back to 121 before we make another charge to new highs. But I think it's pretty late in the game to be long the dollar. I think it's pretty late in the game to be chasing parabolic advances like we have in the S&P. In fact, let me pull the S&P chart up here.
Right.
And I think that Bitcoin was a pretty good example of what happens in parabolic moves, right?
Yep.
So this really doesn't go back far enough, but I do want to show you something on the S&Ps. Of course, has the look of a parabola. We just made new highs on the move. In fact, it's interesting today, after the big down day we had in the S&Ps yesterday, only the S&Ps and the Dow were able to make new highs. NASDAQ didn't, and my preferred short is a Russell, and the Russell barely retraced half or maybe 61.8. So along with the dollar turning, I think there's potential, and this actually may be the catalyst of perhaps at least a 20% correction that I think is going to start before month's end, that we're in a peaking stage here.
Really?
That could take the S&Ps back down towards maybe even the breakout, back towards 2100, 2200 was where this big move began after the Trump victory down here at 2070. So I think that, a lot of people think the world's coming to an end, but it just could be some type of real quick, vicious 20, at the max 30% decline. I'm not a bear calling for, the '08 lows to be taken out. In fact, the Fed's in a good position because the market's so high that even a 30% correction is only going to take it back to what seemed like a pretty good level back in 2015 of 2100. So this is something that I'm paying very close attention to. I just want to point out something that Steve Volge pointed out to me, and it goes back to the debate of whether or not we're in a bubble.
Right.
And here's the argument. Okay, so let's go back to 2000. Okay, so if 2000 was a bubble,
yep,
and we had we had .com there, right? So we had a big advance. If that was a bubble, and then we had another housing bubble in 2007, 2008,
right?
Look at this advance.
Yeah.
How can you say that this is not a bubble?
Yeah, that's
okay. I mean, they dwarf magnitude of the advances that we had into the 2000 top and the 2007 top. Okay.
Yeah.
So Mark, you've never. In fact, I think this RSI reading here is 85, but on the weekly it's 89. And the last time that we had a weekly RSI reading of 89, you can't go back to all my data and find it. In fact, I saw a tweet. The last time we were at these levels in the RSI, 89 was 1929.
Oh my goodness! And we all know what happened then.
Yeah. So, and I'm not saying that's going to happen. I just think that we'll get a real good cleanse because, there are some Super Bulls out there that think that we could see a 4,000 S&P. But we could get a pullback to the breakout at 2100. I don't know what the catalyst will be. Maybe it's going to be political. Kirk Spanos, who you've interviewed, thinks it could be geopolitical. That's where I'm going to move next. I want to talk about the oil because the oil is actually in a similar position to what the euro is. In fact, let me pull the oil up here.
Yeah, sure.
The oil, and what's interesting, the COT, you have record short positions. Commercials are more short now oil here than they were, and this doesn't go back to the highs, but the highs of 140. Okay, if I went to my other charts, 140, they're shorter now than they were up there.
Right.
And I had for a long time, and I talked to different people about it, I had this falling wedge pattern here when we were going through the meltdown and all the MLPs were in trouble and there are problems in the high-grade debt market down here. And this falling wedge, the rule for wedges are that wedges could retrace 100% of the move once they break out. So my targets for a long time were 62.5 or so. So we've overshot this.
Oh, yeah.
right now, okay, and I know a lot of people now are calling for 70, 80. If we do get that hot conflict uh, in the Gulf, uh, you know, who knows where it could go to, depending upon what kind of infrastructure is damaged. But just like what I'm talking about in euro, that it wouldn't be the end of the dollar bear market or a big pullback in the S&Ps, that we could get something similar here in crude. Um, Steve has it pulled back to the breakout. I actually think that we could see something shorter. And just to give our viewers a shorter term look,
Mm-hmm.
let me go to the oil here and pull up a shorter term chart. And it's my contention that we could have one more high in the oil here. I teach that three drive formation. Here's one, here's two. So I'm looking for a third to take out that high. Maybe it's a little cleaner on a 4 hour. But here again, commercials are huge shorts.
Yeah.
Of course, they're underwater on their positions, but um, again, they have deeper pockets. They could be early. They're hedging, and
Yeah.
they're hedging looking at these prices in record numbers, not because they think crude is going to 80. So,
Hmm.
crude, the oils have been pretty good performers in the S&Ps. So this has been another tailwind. A weaker dollar, which I think has also helped crude prices, right? A weaker dollar is usually positive for commodity prices, oil included,
Right.
metals included. So this is another part of the whole jigsaw puzzle. You know, it's interesting when you try and look at things holistically, and especially for people that maybe don't have, decades of experience in the market, it's almost like looking at the back of a tapestry.
Hmm.
And if you look at the back of a tapestry, you see chaotic threads
Yeah.
and no pattern until you learn to turn it around and see the whole picture, and then it becomes clear. So I'm talking about dollar weakness has been a help for equities. It's been a help for crude. It may be drawing to, maybe we're in the eighth inning, seventh inning. Uh, we're headed towards the ninth. And in fact, some people that I highly respect, and Dave, I take the other side of the mic, and there are some people
Mm-hmm.
whose work I really respect, and a lot of guys who say that there is going to be a crisis still believe that the epicenter in the beginning of it still comes from Europe. So maybe it's going to be the Italian elections coming up here. I'm not sure what the catalyst in Europe is going to be, but um, I think that people are going to move back into the dollar away from the euro in the coming weeks. And that's going to be more of a headwind for the market, more of a headwind for energy. And energy, I think, can correct back down towards here's 60. But when I look at this, here's another interesting confluence.
Hmm.
Here you have it right at the 200-month moving average.
Yeah.
Okay, see how that's coming in here. So I think there's potential. I'm looking for one more push up in the crude for short positions. And we've rallied pretty much from, call it 27, let's call it a $40 rally. Why can't we pull back halfway, take it back down towards 45 or so in
Okay.
the coming months, going into the spring or summer? I think that's when the markets are going to be most vulnerable, is going into early spring, possibly before the summer solstice is when I'm looking for some of the air to come out of a lot of these markets that I'm talking about.
Yeah.
And so that's kind of the bigger picture that I wanted to talk about when it came to different instruments. You have a lot of bond bears, and this is something else I just want to point out
Mm-hmm.
quickly.
Sure.
Uh, everyone is saying it's a layup
Hmm.
for higher rates now, and the yield chart does look that way. But the unusual part of the yield chart here is, oh, there's Bitcoin. Okay, so here's the 10-year, And as bad as it looks, I'm thinking that we get maybe one more push down. I want to look for the 30-year. What's interesting is that the short-term rates, your 90-day T-bill rate, has tripled. We've gone from a half to 1.5. Whereas the longer-term paper is grudgingly grinding up to higher yields, and the 30-year even looks stronger than the 10-year. So it doesn't look like the Fed is going to be able to prevent an inversion of the yield curve, and we know that happened twice before in the last 18 years.
Yeah.
And what the result of that is. So we're pretty close to flat now. I believe we're going to invert, especially if the Fed continues to embark on their tightening regimen and run off funds from their balance sheet. So this is another part of the equation. So we've had a weak dollar, we've had a weak treasury market, we've had strong risk. So I'm looking for a turn coming up where you actually could have a nice 30-year rally. Let me see if I go to Steve's, where you might get a flight to quality that's also going to benefit the dollar. It's going to be negative for crude. Let's see if I can find it. There's a 10-year.
Looking for the 30-year.
Looking for the 30. So maybe it's on.
Let's see. That's the 10-year.
Yeah, I think Steve has it. That's Steve.
It's got to be there somewhere.
Yeah. Okay, so here we go. I don't have it, but
that's okay. While you're looking for the
30-year definitely is holding up better than the shorter term rates on this cycle.
Got it. Wow, this is so educational for me. You're schooling me as you always do.
and you know what? I also want to get I like to diagnose the relative strength and the relative weakness. Mm-hmm. So we just saw the S&Ps today, David, make a new high. Mm-hmm. Here was a big break that we had yesterday, right? And it held. Yeah. Mm-hmm. And today we came back.
Back up.
Cleaned out the stops, closed under the high. Maybe there's some more left, but to me this smells like a stop hunt. And then when you look at what the S&P did, making new highs, and then you look at NASDAQ.
Interesting that there's
the Dow made new high, but look at the Russell. Look at the Russell. Not even close.
Yeah.
So this is my preferred short going forward. It's a Russell. And the ironic thing about the Russell is that the domestic corporations were supposed to be the biggest beneficiaries of the tax reform and the tax package. Right. And, we were really performing to the upside in the S&Ps, and it took a tremendous lift in the Dow, S&P, and NASDAQ just to get the Russell to be able to make a new high here in the last several weeks. And then, it was a laggard on the upside. It sold off pretty good, and so far on the rebound that gave the S&P and the Dow a new high, not the NASDAQ. This is a pretty feeble response recovery in the Russell, so the Russell would be my preferred short.
Interesting that the Russell would be your preferred short. Has this historically been the case where is it a safer bet to short the Russell?
I think in the old days it used to be considered more of a, they were tertiary or more speculative stocks because they were, mid cap. Russell 2000, I think it has to do with the capitalization. They're not blue chips. So, so it might have something to do with they were more speculative than, say, for example, the S&P. To be in the S&P, they're, you have your mega cap stocks in there, and the Dow, and the NASDAQ 100.
Gotcha. That makes sense because companies like Apple and Amazon and Disney and Microsoft have plenty of capital to, first of all, buy back shares of their own stock. and also just to create a moat, as Warren Buffett likes to call it, to prevent other competitors from encroaching on their space, on their niche. Whereas these small and mid caps, especially the small caps in the Russell, they don't have that necessarily. They don't have the deep pockets.
I think they're all. I think they're all going to take hits, David. It's just going to be a matter of degrees. So you see here, the Russell did not make a new high yet. Maybe it's got it in there. And also, if you notice on this high, and this hasn't happened in a long time, if we make a new high here in the Nasdaq, it's not going to confirm, just like the S&P made a new high. And you'll see some pretty glaring divergence. I mean, every high we were in the 80s, go all the way back, 80s, 80s, 80s.
Right.
This is the first new high where it's barely 70.
Yeah.
So to me, there's also an old saying that markets bottom in silence and they top with violence.
Right.
So we could, if you notice, we had small ranges. Now the ranges are starting to increase. So, we could have something like this from here and even, another wild swing to the upside. But I think we're starting to get some topping action in here. And with that and the dollar and the crude, I wanted to, make a statement and make as many people aware that there might be a shift in the wind that's been blowing in one direction for a long time, for people to consider paring down risk and perhaps beginning to hedge, because people have decided that hedging is just a waste of money, because everything they've done to hedge in the last several years, all it's done is cost them money. And I think we're approaching a time where it could save their butts.
Yeah.
So I wanted to make this video with you, David, because I think we're there. It's
so
not
glad.
the end of the world, but it's going to seem like it for some people.
Yeah, I'm so glad you're making this video with me on my channel now, because it is time to realize that just because long positions were easy in 2017 doesn't mean they're going to be so easy in 2018.
And for years, David, for years.
Yeah.
And, I want to invite people that hear my voice on this recording to, we have a free room, okay? So I know it says FX Analytics, but we cover bonds and indexes and oil and gold and some crypto. I mean, we don't talk about Google and IBM, but we do talk about direction of indices, the DAX. So it's not all FX, and it is a free webinar, and it's the strongest team that I've ever been a part of, and I've been on many teams, being a journeyman quarterback like Nick Foles and Case Keenum and Bart Bartles. That was the greatest part of last weekend's NFL playoffs, is that guys that were not superstars, that had to deal with naysayers that have been traded around from team to team, had their day in the sun. And I'd like that to give traders that listen to us hope that it only takes one, and these guys could have hung up their cleats a long time ago and given up, but they did not give up. And look, 1 out of 3 of them is going to be in the Super Bowl.
There you go. I joke around a lot with Mr. Dale Pinkert because we're comfortable doing that, but there's a serious message in today's video, which is that it's time to really start taking caution and hedging seriously. Also position sizes. If you're heavily long, really heavily long, it's okay to start taking some profits when markets reach all-time highs. Sure, it could push higher, but you know what they say about the markets: stairs up, elevator down. And when
down is faster.
Yep.
We may be headed into a Sir Isaac Newton phase.
There you go.
Okay, the apple may fall from the tree and hit someone in the head.
There you go.
So,
yep.
Go ahead.
I'm looking at all the resources here on forexanalytics.com. People need to check that out. You got free seminars. I mean, I know Dale puts out, on YouTube and on forexanalytics.com almost every day, free seminars. I mean, just putting the knowledge out there. And then, of course, there's all the different on your website. You got all these resources. Can you tell us about some of the things on there?
Okay, well, this is a traffic light page. You don't want to run red lights.
Yeah.
So this is a page that helps our subscribers navigate all the support, all the resistance. We also have a great education source here.
Yeah.
And, again, what I'm saying is that most services you go to, it's usually one or two analysts. And here we have 6. So if you go to the traffic light page and say, for example, you want an opinion on, let's say, for example, euro. Okay, so you go to euro and you click euro and you're going to get a chart, and this is a weekly chart. Okay, so you could bring it up, and it's kind of the weekly that I just showed. But this is conventional technical analysis, something that I showed. You also get views of Elliott Wave from Grega Horvat. And Grega likes to plot maps. Looks like he's looking for a little pullback here from the levels that we're at. Nicola Duke is well known for her work with harmonic patterns, so you get harmonic looks. Steve Olney does a lot of work with candlesticks, and candlesticks give you very nice signals, so we talk about sticks.
Right.
And we have Stelios Kontos, who writes our macro, who's more the bigger picture guy, and a lot of talent all in one place. Normally you have to subscribe to quite a few services to get this type of coverage.
Yeah, and you get them all, you get a whole team on your side when you sign up at forexanalytics.com, which is fantastic. I mean, just the breadth of analysis here. I mean, you've got candlesticks and Elliott waves. I think I saw some Fibonacci's in there when you were.
Yeah,
when you were
it's all there.
Yeah,
and you know what? The technology is pretty hot too, David.
Yeah.
We have push alerts that when support or pattern and plays are called up, it'll show up right on your screen. And when support and resistance is breached, you're going to get an alert on your screen.
Gotcha.
We also have a phone app, so you don't have to be a slave to your workstation and go out and live your life. And if there's something important happening, you have 12 eyes that are going to let you know, so you could go about your business.
There you go. So people need to check out forexanalytics.com. On Twitter, it is at ForexStopHunter. And I am subscribed. You need to subscribe to Mr. Dale Pinkert on Twitter. I'm also going to put in the description of the video, if people want to contact you just for more information, I mean, they should know that it's a great deal already to go to forexanalytics.com. But maybe they have a question. It is djpinkert1 at AOL.com.
Yeah,
So,
still an old timer using an AOL address.
I've teased him.
You can't teach old dogs new tricks, David.
I've teased Dale about his AOL.com email address, but you're an OG, and that you're one of the originals, as they say. That shows that you've been around for a while, and you've got the knowledge, and you've got a team there that has 6 sets of eyes watching the markets daily. And that's going to benefit anybody, whether you're there for the free content or, better yet, for the premium content. You want to check out forexanalytics.com. And again, the overall message, whether you decide to partake of Forex Analytics, is just be careful. Take profits if you've done really well so far. Don't assume that just because we've been on a rocket mission to the moon with the markets that it's necessarily going to continue like that forever. Trees don't grow to the sky.
Why don't we wrap it up with one picture here, David?
Let's see that picture.
Bitcoin.
Oh, Bitcoin.
Okay.
Oh, it hurts. It's
18,
painful.
And actually, it looks like we might get some type of rally here. But see, most people didn't buy here.
Yeah.
Okay. All the hype started the last several months.
Yep. Yeah.
and I think a lot of people are getting hurt. In fact, I interviewed a guy who said that it was toast, and I think before it's over, we could see 8, 6, and I even saw a guy talk about longer term 3,500. But Bitcoin reminds me a lot of what we saw in 2000, and I know you were around,
Yep.
where anything that had a .com after it
Yep.
had market caps that were just never ever justified, kind of like what's happening with Ripple and some of the other some of the other cryptocurrencies. But out of that, David, came Amazon, came Google, came
Right.
Apple. So it's a good time while these cryptocurrencies are under pressure to educate yourself about them,
Yeah.
so that you could be a grave dancer and pick up great values, because I don't think blockchain's going away.
I tend to agree with that, but small position sizes only, and only after doing your research. And
Right.
yeah, or you can or have Dale's team do some of that research for you, so you don't have to be glued to the screen all day. You can sign up as a premium member for those text message alerts, so that or you can go on the website and the alerts will pop up there for you. But not only it's not just alerts, of course. It's the
I mean, who's going to
resources.
pay 18,000 for one thing? And I know there are people looking for 50
Yeah,
and 100,000.
yeah,
But I mean, up at this range, I'm thinking about buying a car, not a Bitcoin.
yeah.
Down here, maybe, maybe eventually it'll end up being worth as much as a house. But I think you're going to have a chance to, let the market work its excess off, and wait till you see it not being talked about as much.
Yeah.
And when all the hot news starts to die down, then you could start thinking about maybe diversifying and looking for, what may survive and benefit from the next wave.
And only choosing the best of the best among the cryptocurrencies is never a
Yes.
bad idea. And waiting for an actual trading range, a discernible
Yeah.
range, would be nice. I like to play
Yeah.
the range. I don't see a range here. I see.
And wait for more regulation and
Yeah.
more regulated exchanges. I mean, I know there are going to be problems with people trying to get their money back out of some of these unregulated exchanges. So,
Correct.
one thing I learned when I was in Chicago is that if you had your own little brokerage deal going, you want it to be with a clearing member firm, because if the clearing member firm failed, the exchange guaranteed all the customer funds. So I
Right.
don't think that's happening on some of these crypto exchanges.
No, I don't believe the FDIC will cover your Coinbase losses.
Yeah, yeah.
I'm
So
pretty sure
I
about
think
that.
I think we've covered a lot of ground, David. I
Yes,
really want to thank you for having me back. I
absolutely.
go to you have an excellent YouTube page.
Thank you.
You do some great coverage, and some of these ICOs and some of the marijuana stocks, and
Yep.
you get some great guests, and I'm honored to be included on your YouTube page
Well,
with all the people
we're
you've
not
had.
finished. We're not finished with Dale Pinkert yet. He's going to come back whether he likes it or not, and he's going to show us, whether these things actually come to pass, whether his
Yeah.
ideas will actually happen. I'm going to guess they are, because they have consistently.
All right. Well,
So
then let me give you Nostra Pinkert. Let's get together around the spring equinox.
you got it.
Late March, David. Couple
See,
months.
I'm not smart enough to know what the spring equinox is, so late March. I'll write that down. It's been looking at the markets with Dale Pinkert. Thank you, sir. We'll talk to you again
All
real
right,
soon.
buddy. Good hunting. Adios.
Thank you for watching. Please like, comment, and subscribe. And I'll see you next time.